Yesterday, a small ad tech company quietly signed a deal with OpenAI. The stock jumped 11.6%, and almost nobody noticed that. The company is called ZETA Global. And once you understand why this deal happened between them and OpenAI, the people behind ChatGPT, you'll see the entire thesis of AI investing differently. Because this isn't a story about AI winning. This is a story about what AI can't do for itself. Let's also dive into whether this is a good investment for you to get interested in with this investment of ZETA. And if you enjoy long-term investment videos, please subscribe to this channel. I post 5 videos a week on it. Now let's get into the topic of this video, which is about ZETA. On Monday, May 18th, at the 54th JP Morgan Annual Global Technology Media and Communications Conference, ZETA Global's CEO, David Steinberg, confirmed, and I'm quoting him here, that the company has executed an agreement with OpenAI to help OpenAI run its advertising operations. ZETA closed at $19.19 a share, which is up 11.63%, and that's been up 3 straight days in a row. Now on the surface, this looks like a press release, a partnership. 2 companies shake hands, stock goes up, and they move on. But that's not what's happened. What's happened is OpenAI, the most valuable private company on earth, the company that defines artificial intelligence in the public imagination, admitted in front of a room full of institutional investors that it cannot run its own ad business. And so it hired one. And the company it hired is worth less than roughly $4 billion US. That's less than 2% of OpenAI is valued at the current market rate. And that's the story. Now let's talk about why it matters for an investor. Charlie Munger had a line he repeated for 60 years. You don't have to be the smartest, you just have to fish where the fish are. It sounds simple, almost stupid, but every investor who ever blew themselves up, and I mean everyone, broke this very rule. They fished in the most crowded ponds. They bought what everybody else was buying, and they walked past the empty piers, because surely if there were fish in it, somebody would already be there. And that's a trap. Because right now, in May 2026, the most crowded pond in the entire global market is one ticker, NVIDIA. NVIDIA closed Monday at $222 a share. They're all standing shoulder to shoulder on the same pier, casting the same lines, hoping for the same fish. And of course, the fish are there. Munger never said the popular spot was the empty one. He just said it was crowded. But 3 piers over on a lake nobody talks about, a $19 stock just hooked one of the largest fish in the entire AI ocean. And the only people standing on that pier were the ones who read the map carefully enough to understand where the fish are currently swimming. That pier has a name, and it's called AdTech. And the fish swimming under it is OpenAI's monetization problem. So let's talk about what OpenAI is not telling you. In 2025, OpenAI's revenue crossed $13 billion US. By the end of this year, it's projected to cross $20 billion US. Those are real audited numbers. But OpenAI's burn rate, also beautiful but in a much darker way. Reports out of the company suggest annual losses in the ranges of $5 to $7 billion US. The infrastructure costs, the GPUs, the data centers, the electricity, the talent, those are all eating revenue faster than subscriptions can grow. ChatGPT Plus at $20 US a month is not going to close that gap. Enterprise contracts help, API revenue helps, but the math doesn't work on subscriptions alone. There's only one business model in the history of the internet that scales fast enough with high enough margin to fund what OpenAI is trying to build, and that is advertising. Google figured this out in 2000. Facebook figured it out in 2007. TikTok figured it out in 2018. Every consumer internet company that ever reached escape velocity did it on advertising revenue. And OpenAI, with 800 million weekly users and rising, is sitting on the largest untapped ad revenue inventory in the whole world. But the problem is OpenAI has 0 ad infrastructure currently. No targeting stack, no identity graph, no attribution model, no advertiser relationships in place. Building all of that in-house would take years, and they don't have the time to do that. The IPO clock is ticking, and the investor narrative needs a monetization option now. And so they bought one off the shelf from ZETA Global. That's the contract, and that's what was announced last Monday. And that's why that stock moved 11.6%. So who is ZETA Global and why them? They are a marketing technology platform that does 3 things that matter. 1, it owns a proprietary identity graph covering roughly 240 million US consumers. That means for any given email, phone number, or anonymous cookie, ZETA can probabilistically tell you who that person is, what they buy, what they watch, and what they earn, and what they're likely to do next. 2, it operates an AI agent platform called Athena. Athena is the answer-driven marketing layer, the thing that takes raw customer data and turns it into automated, intelligent campaigns. And here's the connection. Athena is already partially owned by OpenAI under a prior collaboration that was announced before this deal. And lastly, it runs an end-to-end ad operations stack, demand-side platform, attribution model, optimization, the full plumbing. In other words, ZETA is exactly what OpenAI would have to build from scratch. And they've been building it for almost 15 years. And that's why this deal exists. It's not a partnership in the soft marketing deck sense. It's an outsourcing contract. OpenAI gets to look like it has ad marketing revenue in place, and ZETA gets to print revenue from one of the most powerful companies on earth. Both sides win, but only one side is currently publicly traded at $19 a share. So if you're tracking this, and I think serious investors should be, here's what matters more than that price today. Watch for three things. First, ZETA's Q2 earnings call. The OpenAI contract will start showing up in revenue guidance. If management raises the full year number meaningfully, the market will re-rate the stock again. If they sandbag it, that's a different signal. Possibly bearish in the short term, but also possibly an opportunity. Next, any major announcement from a second major AI lab, Anthropic, Perplexity, xAI, and so on, the moment a second name signs, the thesis confirms, and the entire ad tech category reprices a second time. Third, trade desk. TTD is the largest pure play in this space. If TTD starts moving on ad adjacent narrative, that's institutional money waking up to the same trade you're reading about right now. This is what Munger meant. You don't have to be the smartest. You just have to be on the right pier before the crowd shows up. Right now that pier is uncrowded, and I don't know how long that lasts. So here's the bottom line. Yesterday, a stock jumped 11.6% because OpenAI, one of the most valuable private companies on earth, signed a deal with it. They saw OpenAI's monetization problem, the ad tech category re-rating it in real time, and 3 more deals that haven't been signed yet, but mathematically have to be. Now, I'm not telling you to buy this stock, I'm just helping you to understand it. Because if you understand this, you'll understand the other trades that look similar to it. And that's the difference between trading the news and reading the map. And if you want to learn more about long-term investments, get tips, strategies, and much more, subscribe to my channel. I post at least 5 videos every week on those subjects.